I've been thinking a lot lately. I'm working hard, paying bills, saving a bit here and there, but my money just kind of sits there.
You sound exactly like me a few years ago. Let me guess. You keep it in a savings account and hope it grows?
Pretty much. It feels safe, but also useless.
Before we dive in, just a quick note. This is not financial advice.
Yeah, we are just sharing what's worked for us and what we are learning along the way.
Exactly. Everyone's situation is different, so always do your own research or talk to a professional before you invest.
Got it. Okay, now help me wake up my lazy money.
Let's get started.
So, why should I even bother investing? Isn't saving money already good enough?
Saving is great, but it's like standing still while the world moves. Inflation makes everything more expensive every year: food, rent, even coffee beans.
Not the coffee beans.
Exactly. So if your money isn't growing, it's basically shrinking. Let's say you have $1,000 today. If inflation is 3%, that same $1,000 buys only $970 worth of stuff next year.
So, my safe savings account is quietly losing value every year?
Yup, that's why investing is important. It helps your money grow faster than inflation, so your future self can actually afford more, not less.
That makes sense. So, investing isn't about being greedy, it's about not falling behind.
Exactly. You're just giving your money a chance to grow with the world. Okay, let's walk through something simple. Imagine someone starts investing $100 a month at age 25. Nothing complicated, just consistent monthly investing. If they leave it to grow until age 65, that could become around $230,000 thanks to compound growth.
That's amazing for only $100 a month.
Right? And here's the part people often forget. If someone starts later, like at 35, the idea still works. They just need to adjust the monthly amount because there are 10 fewer years for the money to grow.
So, how much would someone need to invest if they start at 35?
Roughly around $200 a month to reach a similar target by age 65. Same goal, just a different amount based on when you start.
That feels realistic. People start at different ages.
Exactly. And this ties into what people online call FIRE: financial independence, retire early. It doesn't mean retiring super early or doing something extreme. It simply means understanding how time and consistency work together. The earlier your money starts growing, the more potential flexibility you get later.
So, if someone starts at 40, the idea is the same?
Yes, they would just adjust again, maybe $300 or $350 a month, depending on the goal. It's all about finding the number that fits your life right now.
I like that. It sounds clear and doable, not overwhelming.
That's the whole point. Start where you are, use an amount that's comfortable, and let the consistency do the work over time.
You know what's funny though? I actually tried investing once and I lost $7,000.
Wait, what? How?
One of my friends on Instagram posted that she made quick money with Bitcoin. It looked so real, profit screenshots, everything. So I thought, why not me? And sent money to the broker she tagged.
Oh no.
Yeah, a week later I found out her account had been hacked. The money was gone, just like that.
Ouch. That's a tough lesson, but you're definitely not alone. So many people fall for that get rich quick stuff.
Exactly. It taught me that real investing isn't about fast profits.
It's about doing it safely, through legit platforms, and letting time do the work.
I love that. This time, you're doing it the right way.
Not this time, scammers. Not this time.
Okay, so how do I start investing the right way?
First, open the right kind of account. In Canada, the two most common are TFSA and RRSP.
I see those everywhere but never really understood them.
A TFSA, tax free savings account, lets you invest your money and anything you earn inside grows completely tax free. You can also withdraw at any time with no penalty.
That's awesome!
It is. Then there's the RRSP, the Registered Retirement Savings Plan. That one gives you a tax deduction now, which lowers your taxable income, but you'll pay tax when you take it out later, usually in retirement.
So TFSA equals flexible, RRSP equals long term.
Perfect summary. If you make under around $60,000, start with a TFSA. When your income grows, add RRSPs.
And you can open both online, right?
Yep, Wealthsimple, Questrade, or even your bank. It's super easy.
All right, account opened. What do I buy? Stocks? Crypto? More Pokemon cards?
Definitely not Pokemon cards. Start with ETFs, exchange traded funds.
What's that again?
Think of an ETF like a basket holding hundreds of companies. So instead of buying just one stock, you buy a tiny piece of many at once.
So if one company crashes, it doesn't ruin everything.
Exactly. That's called diversification. Popular beginner ETFs in Canada are VEQT, XEQT, and VFV. They're globally diversified and managed by big names like Vanguard and iShares.
So if I buy VEQT, I basically own part of hundreds of companies around the world?
Pretty much. You buy one ETF and you're instantly global.
That sounds way better than gambling on a single stock.
Exactly. You're building wealth, not chasing luck.
I feel like I'd forget to invest every month.
That's where automation comes in. You can set up an automatic transfer, say $100 each payday, straight into your TFSA or RRSP.
So it happens even if I forget?
Exactly. It's called dollar cost averaging. You invest the same amount regularly, whether the market's up or down. Over time, it balances out and keeps you consistent.
So it's like building a money habit that runs on autopilot.
Exactly. No stress, no overthinking, just steady growth.
What if I open my app and it's all red? I'll panic.
Totally normal. But the key is don't panic. Markets go up and down, but long term, they always recover.
So just don't touch it?
Exactly. Check in once a month, not every day. Think of it like planting a tree. You don't dig it up every week to check the roots.
That's such a good visual.
It's true. Patience grows money faster than panic ever could.
Okay, quick round. Do I need a lot of money to start?
Not at all. Even $50 or $100 a month works. Consistency matters more than size.
Do I need to pick the perfect ETF? What if I choose the wrong one?
You don't need the perfect one. VEQT and XEQT are already globally diversified. The biggest mistake isn't choosing wrong, it's never starting.
What about taxes? Do I pay tax every time my ETF grows?
Inside a TFSA, zero tax. No tax on gains, no tax when you sell, no tax when you withdraw.
And if I suddenly need the money?
You can take it out anytime. Just remember, TFSA has contribution room.
Right, so if I withdraw, do I lose that room?
Not permanently. If you take out $1,000 today, you get that $1,000 of space back on January 1st next year. Just don't recontribute in the same year, or there could be penalties.
So basically, TFSA is flexible, but don't treat it like a daily spending account.
Exactly. Let the money grow.
You actually made this sound doable. I feel like I can start tomorrow.
You can! Open a TFSA, buy a simple ETF like VEQT, XEQT, or VFV, automate your deposits, and let time do its thing.
When I'm rich, I'm taking you to Japan.
Deal. I'll start packing now. And just to repeat, this is not financial advice.
Yeah, we're just sharing what's worked for us and what we're learning along the way.
Always do your own research or talk to a financial professional before you invest. If this helped you, give the video a thumbs up and subscribe for more easy, beginner-friendly money tips.
Thanks for watching, and we'll see you in the next video.